Okay, we're ready to go. Thank you very much. I am thrilled to be here. My name is Marty Kearney. I am representing one of the exchanges involved in the OIC. The OIC is all of the exchanges getting together and trying to do good education for people here in person and people around the world. So I am representing one of the exchanges. I'm actually representing the Chicago Board Options Exchange. And Mark said I've been trading options for 1,000 years. That's a bit of an exaggeration. Next week we'll make 100 years, okay, but it is not 1,000 years. I go around the country. I go around the world. I did some consulting for a bunch in China earlier this year, and that was very nice. But I started, just a quick background on myself, I started trading options as an individual investor back in the 1970s, before many of you were born that I see here, okay, and then I was down on the floor for one of the trading floors for 16 years. I helped start a securities firm that's still around, and I've been in the educational side of one of the exchanges for almost 18 years before I retired. So now I do things like trade at home, put little positions on. And if I don't get, unlike being a trader, they like to trade all the time. As an individual investor, if I don't get a position on at the price I want, you know what? I'm okay with that. Okay, off I go with my little dog, and we walk, and all is well, and I try to put something else on tomorrow. So I didn't put any positions on Thursday or Friday. Okay, I was talking to a group on Thursday, and yesterday I went to a ball game on the north side of Chicago, for you people that know where I'm talking about, so I don't want to irritate any other fans. Mark went through the usual disclaimers, right? And I got some questions about, is the presentation downloadable? For you people at home, it is. We're sending out information now. If you'd like to download the presentation later, you can go to the Options Education website. You can download the material. You can also go and see the presentations that I believe are on some sort of a podcast system. So you can look back and see exactly what's going on. My examples don't include commissions, all right? The usual disclaimers, right? I'm not going to crack jokes because I'm on tape with the disclaimers, but the risks and characteristics of options, you should know it, okay? Yeah, there's some of the links for you, okay? Lots of volume, we know that, okay? That there are a lot of investors using options. And who uses options? Well, we have speculators. I think XYZ is going higher, okay? I might buy a call option. Well, is that pure speculation? Well, maybe not. If it's a stock trading at $300 or $500 a share, maybe buying a call option, I think, could be prudent. If a stock's trading at $500 a share, you buy 100 shares, you're risking $50,000, aren't you? Okay, and lots of stocks have not been splitting over the last few years, so you have a lot of high-priced stocks. So using a call option as a stock substitute, there's good and bad there, right? The benefit is you get leverage. You're not buying a $300 or $500 stock or $150 stock. You don't get the dividend. You don't get voting rights if that's important to you. Okay, but that's all figured into the option pricing, okay? These are some of the exchanges. I've done actually consulting for 4 of those. All right, we're going to talk a little bit about volatility, okay? And volatility sounds like a very complicated idea, but once you dig into it, I think it's not quite as difficult as you think. We have historical volatility that we'll talk about. We have implied volatility. I got a question on how do they figure implied volatility? It's very, very simple, okay? A pricing calculator, before we get into this now, a pricing calculator solves for the unknown, okay? If we know how many days until expiration, I'm looking at an regular October expiration, third Friday in October. I know the number of days till expiration. I know the interest rate, okay? It's pretty darn low right now, okay? You can plug in your own low interest rate, okay? And I know that the stock does or doesn't have a dividend. I know what strike price I'm looking at. I know the stock price. I don't know the current implied volatility, okay? Well, what the pricing calculator does is says, look, if the option's trading for $3 and we have 4 of the big 5 variables known, it solves for the unknown, okay? So Marty has 9 pieces of fruit. He's got 3 apples and 3 pears. How many bananas does he have, right? So that's what a pricing calculator does. Based on the current price of that option, that would imply that we would need a volatility of X%, 28%, to have that option trade for $3, okay? And where options are kind of fun to me is if this gentleman and I take a look at the same option and he says that's underpriced, and I say that option's overpriced, We don't disagree about expiration, the strike price, the interest rate probably, okay? The only thing we're really disagreeing about is what his view of volatility should be, okay? You know, he thinks it's priced too high. I think it's priced a little low. You know, this stock could do something crazy next week, okay? So that's how you can use the pricing calculator to help confirm. That was another question I got online. Kind of confirm your opinion. Why do we, if it's based on supply and demand and this thing's trading for $3 and that seems to be a pretty fair price for buyers and sellers, why do we use the Greeks? Well, we use the Greeks to help us reinforce what do we think, okay? And you will see when you take a look at prices, if you take a look at an option chain, either with your broker or with the OIC, their wonderful website that has the option chains right there, if all of a sudden you see that we're using XYZ. We have the lawyers involved in this, okay, rather than a certain stock, right? But you might see that this particular stock has weekly options, you know, about a quarter of the stocks do, all right? And the implied volatility is roughly here and roughly here and roughly here, and then all of a sudden the next week the implied volatility drops down. Hey, that's an opportunity, isn't it? Why do you think the volatility has dropped down? The earnings are coming out, aren't they? Okay, so the first 2 or 3 weeks of options have the volatility of the uncertainty of the earnings embedded into it, and after the earnings, the implied volatility goes down. So every time you take a look at the Greeks or volatility, and you see something and you say, you know, this looks to be too good to be true. It's been my experience it is too good to be true. Okay, that there's something there. It doesn't mean you shouldn't do anything. It just means that, wait a minute, I have one more thing to take a look at. You know, when is the dividend being paid? When are earnings coming out? You know, what are people looking at? There's lots of websites that you can go take a look at and, you know, what are we expecting on the earnings, right? But anyway, let's dig into the material. And the other thing is, at the very end, a number of you online people, and I love you all dearly, not as much as I love the people in the room here, okay? Everybody waited to send your questions until the very last second. If you have a question as we're going through the material, shoot it in. Mark's sitting there. He's got a fresh cup of coffee. He's ready to go, and he will send out the question to you. And if it's a spectacular question, he might send it to everybody, okay? But he will send you something as best he can, okay? So we've got volatility, right? Volatility ahead, okay? You know, if we take a look at this graph, the dark lines show we've got some volatility coming up, don't we? All right, and in a certain situation, there are certain stocks in certain industries, right, that trade and get a little more than others. You might find utility or something might have very steady volatility, okay? In one of the tech stocks or car companies that make batteries or spaceships or whatever, that stock could be very volatile, okay, based on the news that comes out or what the chairman says, right? So we have low volatility sectors, we have high volatility sectors. Okay, but we're looking at specific stocks within that sector sometimes as to how do those impact the overall sector. And let me just tell you one other thing. One of the people emailed in a question about could I trade the market? Okay, absolutely you can trade the market. But if we take, let's say the Dow Jones Industrial Average, okay? And this is a question for you people at home. You don't have to send an answer in and bombard Mark, okay? We've got the Dow Jones Industrial Average. It's 30 stocks, isn't it? Okay? And let's say that all 30 stocks are trading right now with an implied volatility of the same percentage. So let's just make it 30%. All right? So all the stocks are trading at a 30 implied volatility. And you take a look, and I would like to do something with the diamond. Okay? Now that's the basket. It's one of the baskets for the Dow, isn't it? What do you think the implied volatility is of the options in the diamond? 30%? Higher, lower? What do you think? It's lower. Okay? Why? Because we might have a certain stock. I can use stocks in a basket. You know, IBM's in the basket. Okay? I think Microsoft is in the basket. Okay? And tomorrow morning or Monday morning, IBM could be up $1, Microsoft could be down $1, and the basket is unchanged, isn't it? So baskets have a tendency to trade at a lower volatility than the underlying components. Okay? So if you say, hey, I think the market's going higher and I think it's going to be the Dow, and all of the stocks are trading at a 30 vol, implied volatility, and it's trading at a 26, hey, you got yourself a pretty good deal, didn't you? Here's the problem. When you'd like to get out of that particular option, you're going to be trading it at a very similar discount, aren't you? Okay? So just be aware that volatility on stocks, we've got volatility on different sectors or on bigger baskets as well. They all trade a little differently. They all have different components. Okay? And obviously, certain sectors will change. You know, you might have a stock in a technology sector do something, it affects all the stocks in that sector, doesn't it? Okay, but it might not affect the overall market quite as much. Okay, so historical volatility is pretty easy to calculate, right? We can take a look at a chart and say, well, XYZ has traded in this volatility range over time. Okay, it doesn't mean to imply that that's what's going to happen next week. Lots of crazy things can happen, can't they? Okay. Yeah, so we're into the past performance is no guarantee for you legal people in the group, right? Does history repeat itself? It doesn't always repeat itself, but it rhymes a lot, doesn't it? Okay, it gets pretty darn close to repeating itself. And what you'll see is if you take a look at a chart, pick some crazy stock. You pick your own crazy stock, okay? And if you take a look at the historical volatility over the last year, you know, you might see something where it's like this, and then it drops, and then it's like this, and it drops. It looks like an EKG, okay? What causes that drop? More times than not, it was the earnings came out, okay? So historically, it trades at this level, but as we get closer to earnings, it kind of trades up here, and then after the earnings, it kind of settles back down and then goes back up again. Or going into a product announcement. Sometimes it could be affected by someone else's earnings, okay, because it's a very similar type company. So there is no guarantee, but that's kind of what we're looking at when we're looking at pricing options as to what's coming up, okay? As the stock volatility increases, right, usually the calls and puts go higher. It's not just calls going up or puts going up, they're both going up. There's a, you might want to write this one down, whether you're at home or here. There's a very simple thing, and you can Google it and look it up. It's called the long, L-O-N-G conversion, okay? And it shows that calls and puts are first cousins, okay? If a call goes up in price, the put, all things being equal, the stock hasn't moved, the put should go up as well. There's a mathematical formula where traders are buying calls and selling puts and selling stock. And anyway, there's a whole mathematical formula that keeps the calls and puts kind of in line with each other, okay? So when you take a look at an option and you think, boy, this is kind of an expensive call option, you take a look at the puts, it'll look expensive to you as well. Okay, because it's uncertainty in both directions. High volatility doesn't mean we're going higher. High volatility just means, we'll see it in a second, the probability is that we could move in either direction fairly sharply. That's all high volatility is. Low volatility means, you know, we'll see it in the bell-shaped curve, we're expected to be in a very tight range. Okay? So historical volatility, right, we're looking at standard deviations here. Math gives me headaches at this time in the morning, right? Usually gives me headaches at any time of the day, all right? But historical volatility just means one standard deviation, okay? And you can look this up in a textbook as well. Okay, one standard deviation is 2/3 of the time the stock should trade in this particular area, okay? So it's very, very simple. One standard deviation, we should trade within a certain area, okay? Two standard deviations, it's, as you can see, it's like 95%. You know, three standard deviations, it's 99%. It doesn't mean that we couldn't move even sharper than that, right? Back in September of 2008, the S&P was down, I believe, 108 points. We moved 5 standard deviations. 5 standard deviations is about 1 in a million, if I have my math right. I'm looking over at Dan Gramsa, okay? He knows this math in his head, okay? Back in 1987, when I was on the trading floor, the Dow and the S&P went down, each went down about 23% in one day for you youngsters, right, that weren't around for that. I believe that's like 19 standard deviations. Okay, what's the math on that? I have no clue. Okay, but it seems as if we occasionally get these 1 in a million or 1 in 1,000 days, don't we? We seem to get those a lot more than you would expect over time. But this is based on the option prices, right? Based on where the options are trading right now, that gives us kind of a range that we expect the stock to be in. Doesn't mean we're going to stay there, but it means we should be in that range within a certain amount of time. I have a question. Yes, sir. Hold on a second here. I'm going to, wait, hold on. Uh-oh. This could be critical, okay? Can you hear me okay? Okay. We're on the net. You people at home, watch my lips. Hang on. Is there another mic here? Hold on. Let's see if any of these work. It works? Can you hear this now? Let's go with this. All right? We're good. All right? Hopefully all you people at home can hear me. All right? So you have a question. All right? Hold on a second. I'm going to walk over here, get this question, then I don't have to repeat it. Okay? Oh, his question was that, why am I talking without a microphone? Okay, there you go. Thank you. Thank you for bringing it up to me, okay? Yeah, so, and we're also talking about this as well, and this is where I think that the options get a little confusing, okay? Well, we're looking at a certain amount of time. We're looking at a stock. Here's a stock trading at 100. It's trading at a volatility of 25%. Okay, what does that mean? It means that over a certain period of time, this stock should trade within, pretty simple, $25, right? Okay? But standard deviation, it's an annualized deviation. Okay? Well, I am not trading. When I go back to my computer, and maybe tomorrow afternoon, well, maybe tomorrow night I have to watch a local football professional team play, all right? But tomorrow night I might be taking a look at my screen. I'm not trading options that expire on October 1st of 2019. I'm trading options that expire November of 2018, correct? Okay? So what you have to do is that the whole, when we go to the website at OIC or your broker's site, they're kind of helping you change that from an annualized standard deviation to a deviation out to the expiration you're looking at, regular October or October 10th or October 30th or November 17th or whatever expiration you're taking a look at, okay? Once again, a very simple formula to give you the range that we are expected to be in. I could give that to you real quickly, too. Maybe I should have had a slide on this, okay? Write down this formula. This is the last math problem I'll give you today. But it is on your final exam in 40 minutes, okay? So be ready for the exam, okay? I'm taking Dan, help me here if I do this right. We're taking the stock price. We're taking a $60 stock, okay? And we're taking November expiration, okay? There are 49 days until expiration. I'm using that number for a reason, okay? Interest rates are, well, I'm taking the stock price times the square root of 49, which is 7, okay? So I'm taking the stock price times 7 divided by the square root of a year, okay? So the square root of a year of 365 is like 19.1 or something like that, okay? What I'm trying to do is convert this annualized standard deviation down to an expiration going out in November, which is 49 days. So in this case, it would be what? It would be a $100 stack. It would be 100 times 0.25 times the square root of 49, which is 7, divided by 19.1, and you would come up with something. I don't have a calculator right in front of me here, okay? But what you might have is there, hey, one standard deviation between now and November isn't $25. It could be $470, okay? So what that means is 2/3 of the time at this volatility, we should be closing between 95.30 and 104.70, 2/3 of the time. Okay, 95% of the time we should be, an extra 470 out from there, shouldn't we? Okay? So it's very, very easy, and I happen to like that because if I'm doing something like a covered right, okay, where I own the underlying shares and I'm selling call options against it, this kind of gives me an idea, what is the probability that that stock will be called? I've got a $100 stock, I'm looking at the 105 call in November. Well, the probability is it will stay within 95 and about 105, isn't it? Okay, so the probability right now at this instant, based on where the stock is and the current implied volatility, is we should be in a range. It is a low probability that I will be assigned early, okay, or be assigned if we're over 105. If we get up above 105, I can always buy the option back if I want to, right? But still, the whole idea here is that There are so many things that the option world tells you. I know a broker outside of Washington, D.C. that uses options for his clients that don't use options. All right? He's got, his company is a full-service firm, and they say, hey, we like 2 stocks at 60, and we both have $70 targets on them for year-end. One stock is trading with a 20 volatility, one stock is trading with a 40 volatility. Okay? Now, Marty's Aunt Marilyn, okay, I'm going to call her 91. I think she's a little older, but she could see this on tape, okay? Maybe that stock that has the 40 volatility is inappropriate for her to buy the shares of, even though our firm loves the stock. Maybe for her, I should be buying the $60 stock with the 20 volatility. Okay, she doesn't need wild swings, does she? Okay, so there's so many good little tidbits that option prices can give you, even if you're not going to trade that stock or that option. Okay? Right, so as you can see here, stock A has a 15% volatility. Most of the range is going to be pretty narrow, isn't it? You know, stock C, we're not at a 15 volatility, we're at a 35 volatility. It kind of smooths out. Okay, our range is expected to be much wider. Right, so this is what different volatilities mean when you're looking at a higher volatility on a stock. You know, 2 stocks that trade the same, that we just said, $60, 20 vol, 40 vol, same thing, wider range in the 40 volatility. Okay. Where will the market go next? Well, we don't have that presentation available for you. Okay. All right. Yeah, so we're looking at pricing models here. All right. And we're just looking at the implied volatility. Who determines the option market prices? Well, everybody. You know, as Mark said, it's, you know, market makers are involved, but it's buyers and sellers, aren't there? Okay, that they come in and they think, well, it's $2 bid offered at $2.20. You know, I'd like to pay $2.05. There you go. Now we have a market, don't we? It's $2.05 bid offered at $2.20. And he says, well, I'd sell those at $2.15 if push came to shove. Now we have the market. It's $2.05 offered at $2.15. All right, and markets can change based on where the stock goes or news that comes out. Okay, but everybody participates in this, and we're thinking somewhere around 210 at that point seems to be kind of a price of indifference, doesn't it? Both buyers and sellers, you know, that's kind of a point where neither one of them thinks it's great, neither one of them thinks it's terrible, but that's kind of the midpoint there. Okay, yeah, so implied volatility kind of points to where do we think we're going in the future. Okay. And only options have implied volatility. Stocks don't have implied volatility. Stocks can be volatile, but they don't reflect it in any implied volatility in the future. Okay? And predicting the stock volatility, you can be right or wrong on that. You know, ordinarily, though, as I said, if volatility is going higher or it's going lower, there's a reason for it. Okay, we're going to have a little bit more uncertainty or we're going to have a little less. Hey, XYZ is going to have an announcement after the close on Tuesday. Well, implied volatility might go up, right? They come out with the announcement, one of the Kearney boys is named to the board of directors. Well, the volatility should go down, okay? And maybe the stock goes down too, all right? But still, the news is out, okay? And there are other variables with this. The market has a big play in what the stock will do in that sector, as well as the company having news, but that one unknown is now behind us, okay? And volatility, it can change intraday, okay, and over time, okay? Let's see what we have here. Well, in options, implied volatility returned to an underlying stock historical volatility. Close to it. You know, if a stock has been trading at a historical 30 volatility, and now we're trading at a 40 volatility because there are earnings next week, okay? The earnings come out, the stock's going to move where it's going to move to, but the implied volatility doesn't necessarily drop right back down to 30% or lower, does it? Okay? After the earnings, it might drop down to 35%. The next day, it's 33.5%. Well, why is that? Well, you know what? We might have some of the big Wall Street firms say, hey, we're raising our recommendation on the stock. Okay, we're raising our target price from 60 to 72 over the next 12 months. There are some other variables that could happen once the news is out. But traditionally, the implied volatility comes down and at least approaches its historical volatility. Okay? Why be concerned about volatility? Well, it kind of affects how we're going to price these options, doesn't it? And as I said, he thinks an option is overpriced. I think it's underpriced. The only difference we have is the implied volatility. All right? I think it's underpriced because I'm thinking some of the events coming up in the next couple of weeks might make that option just a little bit more expensive. Yeah, so as I said here before, this is the Department of Redundancy department. Okay, as implied volatility goes up, both call and put prices should go up in value. As volatility decreases, they should both go down on the call and the put at the same time. Okay, you're looking up that term long conversion. If you want to be real energetic, you can look up the term reverse conversion. Okay, these are trades you will never do. Okay, but this is how if a trader on the floor, if they sell call options to hedge themselves, they might go buy the underlying shares of stock. But now they basically have the covered right on, don't they? All right. To protect themselves a second time, they might go buy the underlying put. So this is kind of all baked into the formula of how do we come up with these option prices. You wouldn't do that. It's 3 transactions in, 3 transactions out, and it doesn't work for you. Trust me. Okay. The traders might do it to hedge themselves. Okay? If you're long an option, right, and let's just call it a call or a put, obviously you want the price of that option to go up. Okay? Having the implied volatility go up doesn't hurt you. Okay? So we have 2 things working for you there. Will the stock go the right direction? If it's a call, I'd like the stock to go up a little bit. But if there's a little more uncertainty about the stock, that might add to the little jump up in price that option is now trading at. If you're short an option, a call or a put, okay, we've got other factors there. We've got time working for us, right? But if you're short a call, you sure would like that, call option to decrease. Maybe it's because the stock backs up a little bit, okay? And maybe it's because volatility comes down. All right, so both of those would help you if you are short an option, okay? And you may hear the term short premium. That just means you're selling options and collecting the proceeds. Okay? Yeah, the change in underlying stock volatility, right, it's not required. You could have a situation where, right, here's the stock trading at 50 and the option's trading for 2, and all of a sudden you look up and it's trading for 220 and the stock hasn't moved. Well, we haven't changed interest rates or strike prices or days to expiration. The stock hasn't changed. There's a little bit more uncertainty. Okay? A lot of times you can't even see what it is. Maybe all of a sudden some big firm came in and bought lots of call options, and someone else bought some put options, and there's a story about the stock right now. You know what? The stock hasn't moved. It's trading like water at $50, isn't it? But there's a little bit more uncertainty, at least for a short period in time. Okay? Maybe that volatility will come back out once things settle down a little bit. Supply and demand obviously has an impact, right, in volatility. If the stock is at 50 and people are buying the $2 call and then they're buying the call for 205 and now for 210, you know what? That's pushing the volatility up, isn't it? Okay, at least temporarily. All right? Yeah, and what causes these uncertainties, rumors, earnings expectations, et cetera? Lots of things can cause the volatility to jump. Okay? It could also be, as I said early on, it could be the stocks in the same sector, or it could be a basket of those stocks. Okay? Right? We got lots of things that can happen. Economic data, you can see everything here. Oil prices have been kind of in the news lately, right? We get up above 70, it kind of scares the market a little bit. It makes the oil companies very happy, that their prices go up a little bit. Okay? But at some point, maybe oil prices going up too much could impact the overall market. Maybe the volatility goes up a little bit in some of these baskets. Why? Because people might be buying protected puts. Okay? And when the market is active, things are fine. If the markets are in doldrums, nothing's happening, traditionally, implied volatility drops slightly, doesn't it? Okay? Why? Complacency. Okay? Market's not doing anything. Maybe you take a look at your broker's website, or you go to the OIC website at noon on Monday and you see, hey, the Dow Jones Industrial Average is up $2. Literally hundreds of dollars are changing hands on Wall Street, right? This sounds very, very exciting. But you know what? Implied volatility in many of the components, because those components aren't moving, that implied volatility could be dropping just a little bit, couldn't it? Why? Nothing going on. No need to buy calls. Certainly no need to buy puts. Okay? I don't want to sell things, right? Just kind of complacency, everything's fine, and implied volatility drops a little bit. If the market goes higher, you know, you have some people saying, I think it's going to continue. There are momentum players, right? You also have some people say, well, I think it's getting a little high. Maybe I'm a seller, okay? But you know what? Traditionally, as markets go higher, the implied volatility comes down a little bit because the overall worry of the marketplace is not there. Traditionally, stocks go up, volatility comes down slightly. If stocks start moving down, you know what? Now I'm worried. Okay, I've got that dog to feed at home. He's a 25-pounder. He eats lots of... he came from a shelter. He now eats organic dog food. I don't know. Anyway, let's not get off on that tangent, okay? And I love dogs, you people at home, okay? As everybody here knows, all right? But if the market drops, the implied volatility usually jumps. Why? Uncertainty. Hey, this market's getting a little crazy. You know, should I sell the stock I own? Should I buy a protective put? What should I be doing? Okay, certainly don't want to buy stocks right here, but I'm thinking about selling stocks. Implied volatility goes up traditionally, okay? So there are, you know, points worth repeating here. Lots of factors affect the, you know, implied volatility, right? And obviously, as Mark said, you know, we don't live in a vacuum. You know, just one of the Greeks doesn't change traditionally, okay? And I've seen presentations. They're starting, Mark had everything on the right way in this presentation, but I saw presentations over the last few years where they talked about the Greeks. They left out interest rates. That's not important. You know, interest rates are zero, aren't they? Okay? You know what? Interest rates, as they start to rise, they certainly do have an impact on stock prices. I'm going to ask the local crowd here a quick question, and you people at home think about it, okay? Here's a stock at $50, all right? And the interest rates are, let's just call them 3%, okay? And so the option's trading for $2. The 1-month option's trading for 2. Stock's at 50, 1-month option at 2, interest rates 3%. Okay, and Mr. Fisher on the Fed, people didn't see it, you were in the meeting here, he just said he's raising interest rates Monday from 3% to 6%. Okay? Let's assume that the stock stays at $50. Will the call option, I'll do a show of hands and I'll tell you people at home how it worked out, okay? Do you think the call option would go up in value or down in value? Stock at 50, interest rates just doubled. We haven't changed the number of days till expiration. How many people say that the call option would go up in value? Okay, about 10% of the crowd. How many people say that the call option would go down in value? About 60% of the crowd. The rest of you, keep in mind, you can vote early and vote often, okay, in this general area here. If the call option, if the interest rates just went from 3% to 6%, the call option just went up in value. Now, why is that? Hey, I'm thinking about buying this $50 stock. Instead of buying the stock, I'm going to buy a call option and put $5,000 in the bank and earn 6%. Does that make sense to you? So the call option, if interest rates rise, the call options should go up in value. Now, with doubling the interest rates, you know, you're thinking, wow, you know, I hadn't thought about that. What do you think that $2 call should be trading at? With all of the inputs the same, that option should be trading for, I don't know, 204, 203? Okay, not much more. Why? Because it's only 30 days out, isn't it? Okay, but if we start taking a look at options 6 months, a year out in time, those calls just went up pretty sharply because people will be using call options as a stock substitute. Okay, so Mark had it right. He had row on there, but the interest rate, in the interest rate, remember, all of the components of the Greeks, it's 1. You know, the stock moves 1 point. You know, that's delta. You know, implied volatility moves 1 point. That's vega. Rho is a 1% change in interest rates. The interest rates haven't changed 1% in a long, long time, have they? Okay. So the interest rates moving a little bit shouldn't affect option prices. If you're looking at the 10-year and it goes from, you know, 307 to 302 or 307 to 310, the interest rates to me haven't changed with a short-term option. Okay, but looking longer term, it certainly affects the option price. Okay. Okay, we're going to buy a XYZ December 50 call. Okay, at $3. There's 30 days until expiration. Okay, and XYZ stock fluctuates. The December 50 call increases Where are we here? 60 days until expiration. Okay. Oh, the next day, the stock is still trading at 50, but the option's trading not at $3, $3.40. What caused that? We had 1 day of time decay. Okay. You know what? It's probably the implied volatility, isn't it? Okay. Well, the implied volatility, and you could look at a pricing calculator, the implied volatility would have to go from 35%, maybe up to about 40% to have that option trade at that price. Hey, Marty, you said this option, we lost a day of time premium, right? The option that was trading at 3 should go to 290 or 296, 297 with theta, with time decay. Yeah, but the implied volatility kind of overrode that 1 day of time decay, didn't it? Okay. Yeah, so you could write the call option, and tomorrow the stock hasn't changed and the call's up. Why did that happen? Well, they don't have your picture on the trading floor or on a computer somewhere, okay? It's some exchange. It's just that implied volatility, the uncertainty about the stock just went up. There was news after you sold your option, okay? Yeah, stocks at historical volatility, that's just it. It's history, isn't it? It really has nothing to do with how I'm thinking about the option, other than it gives me kind of a benchmark as to where the implied volatility could drift towards at one point or another in the future, okay? So the implied volatility is based on my expectations of where the stock could go, okay? And it's a standard deviation, right? In one standard deviation, 30%, that's over a year, all right? And I have to convert that down to what do I think the range will be in the time between now and the expiration that I chose, okay? So in this particular case, right, XYZ is trading at 80, 30% implied volatility. 30% implied volatility. That means it should trade within $24 over the next 12 months, okay? And it should trade within, what, 48 points is 2 standard deviations there, okay? That math is pretty simple, okay? So let's take a look. How do we take advantage of volatility with strategies, okay? Well, to me, this is what I do. If I think volatility is low and I'm a buyer of something, I'm usually just a straight-out buyer of the option, okay? Volatility is low, I'll buy the option. Okay, I think the stock's going higher, I'll buy a call. I think the stock's going lower, I might buy a put, okay? Why? Because it seems to me as if the implied volatility looks cheap to me. I'm looking at the stock movement, I'm looking at the implied volatility over time. It seems to kind of be in a range where I'm okay with this. Okay? I'll tell you what I do with high volatility in a second. I don't want to get ahead of myself. Okay? Well, one of the things you can do, we're going to talk about something called a straddle. Now, I was talking early on to my friend here, okay, about these strangely named option strategies. Okay, where do they come up with these crazy names? Okay, what I've told people before is one of the exchanges, when somebody comes up with a new strategy, they reach into a basket and they pull out a name and they go, we're going to call this the straddle. Okay, no, that's not how it happens, all right? But what happens is some of these strategies that sound complicated are just a combination of 2 very simple strategies, okay? And in this particular case, I think this particular stock is going to make a move, okay? It says here maybe there's a drug trial. There are new things coming out. The FDA is going to rule next week on XYZ. They've got this wonderful drug for old men with gray hair, okay? And they think some people might buy that, or maybe their spouse does, okay? So you know what? I'm not sure, though, is the news going to be great, and this stock goes from whatever, from 85 to 100, or does it go from 85 to 50, okay? So I'm thinking the options look fairly priced. I might do something called buy a straddle, okay? And what I might do is this. I might buy the stock is near 87.50. It doesn't have to be exactly there. But I'm going to buy an at-the-money 87.50 call, close to at-the-money, okay? And I'm going to buy an 87.50 strike price put. The combined price looks to be about $4. Now, to me, this is a very low-level approval from your broker, isn't it? You'd like to buy an option? Most everybody, if you've got $400 in your account, you can do this, can't you? Okay? To me, this is a little bit aggressive. Okay? This isn't a conservative strategy. You are making a bet here. I don't like the term bet with options, but this looks like a bet to me, right? And if the stock is trading 87.50, I'm saying this stock, you're going to see it on the next page here, Okay, we're not going to do the short one, okay? But on the next page here, you're going to see that I have to have this stock $4 higher or $4 lower to break even, don't I? Now, once the news comes out, the stock's going to make a move, isn't it? What do you think will happen to the implied volatility of these options? Traditionally, it should drop pretty sharply, shouldn't it? You know, why is it so high right now? Well, because we're looking at, we're looking at news that could be significant one way or the other, right? So, to me, this stock has to move. What is this? This stock has to move 5% to break me even, doesn't it? Now, if the company comes out or the FDA comes out and says, you know what, on XYZ, we've decided to delay our decision for 30 days. Now what? Okay, the stock is still trading at $87.50. Maybe those options go from $4 in a heartbeat. They're trading at $3.25, aren't they, combined? Okay, maybe this isn't the right strategy right now. Get out of the position, take your loss. Taking a loss is one of the most difficult things. That took me a while down on the trading floor to do that, okay? But it doesn't fit with my current outlook right now. The news will be out past, right, the 45 days until expiration. This is the wrong option. Okay, it's the wrong expiration. It's not the wrong option. It could be the wrong expiration. I'm going to get out of it, take my loss, and be done with it, okay? So what's my maximum risk? $4. This stock could stay right here at $87.50 and everything expires. What's my maximum gain potential? Well, theoretically, unlimited. I've never owned a stock that went to unlimited, okay? But theoretically, the idea here is that the potential gain could be significant, okay? So, maybe the stock is trading at 60, maybe it's trading at 110. Okay, I don't know. Okay, what do I do with it? Let's just say for fun, let's just say that the stock, and by the way, whenever you see a straight line, so you people at home with the blue here in Naperville here, if you see a straight line when you're looking at a profit and loss graph, you're looking at expiration Friday, okay? Because if I buy it today at this time in the morning, 10:30 in the morning, I could sell it. If I buy it for 4, I could expect to sell it for near 4 an hour from now, couldn't I? All things being equal, okay? But still, when you see a straight line, we're looking at expiration Friday. So obviously, things can change a lot between now and expiration Friday, in this case, 45 days away. But you can see how far this stock has to move to break me even. So, low approval to buy the straddle, but a little aggressive. And what happens now? The stock opens at 100. You know what? Now, I am a certifiable genius. I bought the straddle, okay? I didn't buy it as many times as I wanted to. I only bought it once, okay? But the position that I spent $4 for, right, with the stock at 100, the $87.50 call is now should be worth at least $12.50, shouldn't it? What's the 87 put worth? Not much, okay? What I do with something like this, and this is where you might do this on an earnings situation, okay? And let's just say you bought 5 of these things, okay? Well, the news comes out and the stock opens the following day and the stock opens at 100. I might be selling 3 of these options right now. Why not all 5? Well, because I'm greedy, okay? But I'm selling 3 of these options right now, the call options. I'm not doing anything with the puts yet, okay? Why? I'm hoping that all of a sudden one of the Wall Street firms says, hey, we love the stock now. It's a $130 stock, okay? Maybe it creeps a little bit higher. But I'm not hanging on to this. Remember, we're looking at profit and loss at expiration with those solid blue lines. If I'm doing this trade, I am not holding this position until expiration. I'm holding it till the event. I'm out of half of it when the news comes out, and I'm out of the balance of it shortly thereafter. Maybe the same afternoon. Maybe the following morning if I want to get a little crazy. Okay. What about the puts? Well, they're trading for 30 cents, 20 cents right now, right? You paid $2 for them. You paid $1.85 for them. What I'm hoping for there is, the stock trades near 100, and it kind of backs up to about 95 or so. You know what? Maybe those puts are trading for 40 cents. Good. I'm out of them. Okay. I'm not hanging on to those either. Okay. But there's no need to exit the whole position. We know what our risk is on those puts, right? They're trading for 30 cents. We're risking 30 cents. Okay. So I take a profit. I don't hang on to things like straddles until expiration Friday. That's not what I'm into. I'm not holding it till expiration. Okay. Here's a strangle, another great name. Okay. We've got the same idea here. Okay. The stock is trading near $87.50. I don't want want to spend $4. Okay? I'd like to spend something else here. All right? Well, this is actually going to be, the math isn't right on this, but go with me on the concept here. The stock's near 87.5, okay? Here we go. Let's look at this one, right? Here is the strangle. I'm going to buy the out-of-the-money 90 call, pay $1.20. I'm going to buy the out-of-the-money 85 strike price put for $1.30. So I'm not spending $4. I'm risking $2.50, aren't I? Do you see that? It's still an aggressive trade. The stock has to go, right, to 82.50 or 92.50 to break me even. So still an aggressive trade, okay? And you can see at expiration, you know, I've got a little bit wider range that I could actually lose money. Now, once again, I'm not holding on to this until expiration, okay? I'm holding on to it until the news. And if the stock opens at 100 and I owe the 90 call, hey, it's worth $10, isn't it? Same idea. I'm out of half the position or thereabouts, you know, pretty soon, and the other half shortly thereafter. And the puts, I'm just playing with those. Or on the way down, same thing. If the stock doesn't really move, you know what? I'm going to get out of the entire position pretty quickly. So limited risk, and I'm taking two very basic strategies, combining them together and giving it a crazy name. The straddle, I am straddling the same strike price. The strangle, I'm using out-of-the-money calls and out-of-the-money puts to own my risk. Pay less, different break-even points, okay, but a very similar type trade. Right, so a straddle, higher cost, your break-even points are a little closer together, okay? And remember, you know, with these trades, you're going to trade out of these, or you could end up with a longer short stock position, aren't you? That's another reason we're not going to hang on to these until expiration. Now, maybe that's something you like. You know, I bought the 87.50 call or the 90 call with the straddle or strangle. Stock's at 100. I'd like to add this stock to my portfolio. Great. Okay. At expiration, you will exercise automatically. Someone will be assigned, and you will be the happy owner of that stock at either 87.50 or 90. Okay. But if you don't want the stock to be long or short, then you're going to be trading out of this either way. Strangle, lower cost, different break even, usually slightly further apart. Okay. Both time decay is painful. Oh, yeah. Time decay is painful. And you do need a stock movement, don't you? In that first example, about 5%. The strangle's slightly more than that, okay? Right, so why are we doing that? Okay, well, because the volatility, I think, is a little bit low. So what do we do if I think the volatility is high? You know what I'm doing? I'm doing a vertical spread. I love this particular stock. It's trading at 90. I think this thing could go to $95, $96. Okay, but I don't want to buy the stock. I think the call option seems to be high with implied volatility. I'll buy the 90 strike price call. I will sell the 95 strike price call. So I have no stock position. What do I have? I have the right to buy the stock at 90. I have an obligation, if called upon to do so, to deliver 100 shares at 95. It is covered by the 90 call, isn't it? So instead of buying the 90 call, risk 205, my break even is 92.05. I'm not adding in commissions. Okay, by bringing in $1.35, my break even is 91.35. Okay, but I only have the potential up to $95. I'm giving up everything beyond that. Hey, I'm a reasonable guy. Okay, I just said before I'm greedy with some trades, but I'm a pretty reasonable person. Okay, if this stock goes up 5 or 6%, you know what? You can have the balance of it. I'm not greedy. Okay, I just want to move from 90 to 95, and then I'd like to be out of this thing. Okay, this is called a bullish call spread. You will hear this known as a vertical spread. Same stock, same expiration, different strike prices. Both calls or both puts. This is both call options. So this is a bullish call vertical spread. Okay, right. What's the most I can make if we're 95 or higher? The 90 call is worth, you know, 5 at 95. The 95 call is worthless. The spread can only go as wide as the difference in the strike prices. I paid $1.35. Most I can make is $3.65. Okay, and you know the area where you have to be concerned is if we're right near 90 or we're right near 95. Will I be assigned? Will I not be assigned? And a short 95 call, maybe you should trade out of it. If you don't want a stock position come after expiration, maybe you're going to trade out of this. Okay? And that's the profit and loss graph, once again, straight lines, right? We're at expiration Friday. This I could hang on to a little longer until expiration Friday because, you know, I've lowered the time premium down. I've also minimized some of the impact of high volatility. Hey, I bought an overpriced 90 call, overpriced in my mind. Okay, you know what? The 95 call is trading at a very similar volatility. Doesn't have to be the same, doesn't necessarily have to be higher, but they're both elevated, aren't they? So I'm reducing the impact of volatility, I'm reducing the impact of time decay. What do I get? A lower price. What am I giving up? All movement above 95, right? Okay. Right. We could also do a bear put spread. We'll give you a quick example, and we'll see what kind of questions you have, okay? In this case, I think the stock's at 88.50. I think we're going lower. I'm going to buy the 90.85 put vertical spread. Hey, look at this. I just bought an option, the 90 put that is $1.50 in the money. I have the right to sell it at 90, don't I? Okay? That option is intrinsically worth $1.50. All right? So I at 88.50, so I'm paying about $2 worth of time premium. Hey, I'm selling the 85 put. I'm collecting $1.80 of time premium. By paying $1.70, the stock at 88.50, you know, my break even, I only have to have that stock down, what, 20 cents from 88.50 down to 88.30 to break myself even. Okay? I don't need a big movement to go lower. So many people look at vertical spreads with out-of-the-money options or at-the-money options for one of them anyway. This is an in-the-money vertical spread. Okay? What's my risk on this? Well, I spent, what, $1.70? My risk is $1.70. What's my potential gain? Same idea. Difference in the strike price is $5 less $1.70. It's $3.30 is my potential gain. And this is what this looks like. Okay? Right? This is expiration. 90 or higher, I lose the whole thing. It's got to get to 88.30 to break me even. And I do well below that level. These numbers don't include the commissions, right? Which shouldn't be too high. Okay, and my potential gain is $3.30. So risking $1.70 to make $3.30, I think with my outlook, that's a pretty good risk reward with this strategy. Okay? Right, so this is, just as a quick review, then we're going to see what kind of questions people here have or at home, okay? Send those questions in now, you people at home, so we don't bombard Mark, okay? Right, when we're looking at historical volatility, what has the volatility been of this particular stock over time, all right? What is the, or you could actually take a look at the historical volatility of an option, too, if you wanted to, all right? The implied volatility, you know what? Based on where this option is trading now, time to expiration, interest rates and dividend, strike price, stock price, that implies that the option trading at this amount, okay, and it's usually figured, by the way, at the midpoint, okay? If it's $2 bid offered at $2.10, they're usually figuring that the stock, that the option is trading at $2.05, okay? That would imply that we would need a volatility of X% to have that option trade at 205. Okay? Long straddles, long strangles, low approval level, I think a little aggressive. It might not be for the person that does their first trade, but for the person that says, hey, I think this stock could rock and roll, how do I play this? Do I play it from the long side or short side? Could I play both? There's a way to do it either with the straddle or the strangle. And if you think volatility is high, you know what? And you have a directional opinion, what I do is I do vertical spreads. Nothing wrong with vertical spreads. Okay? Lower my break-even point, take some of the impact of high volatility out of the equation. Not all, but some of it. Okay? And I have limited gain potential, but I have limited risk, and the risk is lower than an outright purchase of an expensive option. Okay? All right, we've got some tools there at optionseducation.org. Let's do the questions. What questions? Yes, sir. And I'll wander down and get your question, okay?
Yes. Could you explain volatility skew and how an individual investor can use it during their trading?
Okay. His question is an advanced question. It's called volatility skew, and how can an investor take advantage of that? Volatility skew just means this. The stock is trading at 87.50, okay? The 85 put might be trading for a 20 volatility. The 80 put could be trading for a 21 volatility. 75 put could be trading for an 82 volatility. This is called skew. The further out in time we go, the implied volatility is fractionally higher. You see it more on baskets, like SPY, IWM, things like that, where there are maybe 1-point strike prices. Okay, how does an individual investor take advantage of skew? Well, the only way you're going to take advantage of skew is for an investor, is probably some sort of a vertical spread. You're taking advantage. I'm buying the 20 volatility, I'm selling at 21 volatility. But if the stock or basket moves sharply, the option I own might be trading at a 25 volatility. The one I sold could be trading at a 26, couldn't it? Okay, because that skew could very well be there. Maybe now that they're in the money, the skew comes in a little bit. It's less. But skew is just where you see that it looks like the options, the further strike price-wise we go, the volatility changes a little bit. There's not much an individual investor can do to take advantage of that. Okay, but it's there, and it just means that like things like insurance, further out in time, the insurance gets not further out in time, further out in strike price, the insurance is difficult for traders to hedge off. They're buying other things, and they're pushing option prices a little higher than they normally would be. Okay? Yes, sir. I'll repeat your question here.
What do you use to define the strategy you use to your implied volatility as it compares to actually over a period of time, let's say 12 months? The range of volatility you have right now, your implied volatility.
Right.
It might compare to, let's say, the last 12 months.
Okay, so the current implied volatility kind of seems very similar to its historical volatility. Okay.
Right, but what if your implied volatility at this period of time is way higher?
Yeah, if the implied volatility is way higher, there's a reason for that. And this is where you have to do a little digging and dig down and say, you know what? Earnings are due out in 2 weeks. Okay? And are the earnings going to be good or are they going to be bad? Will it affect the position I have on? Would I like to put a position on for the earnings? If I do, I have to realize the implied volatility is high. Is there a way I can take advantage of that? Okay, and maybe it's by a spread. I showed you a vertical spread. Okay, but after the earnings, maybe they will come down to their more historical level, and I won't be impacted as greatly if I have a spread on as opposed to just buying an option. Yes, sir.
If I put on a long straddle,
Mm-hmm.
do I want my stock to have high volatility or low volatility?
Okay, his question is if I'm initiating a trade with a long straddle, would I like my stock to have high volatility or low volatility? In a perfect world, I would like low volatility. But usually with a straddle, what we're looking at is everybody knows this earnings event is coming up. So options are moving a little bit higher. What some people are doing is they're looking at historically, like right now, we're looking at a move of, with the current volatility, we're looking at a move of like 3% or 4%. You might say that's okay. That's still, even with higher volatility, that's okay because I've taken a look at the last 8 earnings announcements, and do you know the stock has usually moved 7.5% to 8%? Okay, so maybe even though the volatility is a little higher, based on if it acts as it has in the past, maybe I could still do very well buying a little bit expensive volatility. So in a perfect world, you want low volatility. In the real world, everybody knows that earnings are coming out. Those options should be up a little bit with their implied volatility. Mark, you have a question.
Yeah, Marty, we're talking about volatility. Somebody is asking about the VIX index, and if maybe you could just give a little brief explanation of what the VIX is and how it works.
Yes, the VIX is the measurement of the volatility of the marketplace as measured within the S&P 500. So when they are using when you hear the VIX, they are talking about the volatility of the S&P 500. Okay? It's a very simple calculation. They take all of the strike prices in the SPX for the first 2 months, and there's probably only, 600 of them. Okay? And they come up with a constant at the money to wherever the S&P is. They take going out 60 days, right, and they come up with a constant 30-day maturity, and they take a look at what is the implied volatility of every option in the S&P, okay, as measured by the SPX. That's the full-size index, not the SPY that is 1/10 the size that's an ETF, okay? And so all they're doing is they're updating it every 10 to 15 seconds. All they're measuring is the outlook right now for constant 30-day maturity. So the VIX today, you could compare it to the VIX a year ago. Well, wait, the S&P was 300 points lower and interest rates were this. It doesn't matter. Okay? We're comparing a 30-day at-the-money option that our computer just made, comparing it to a 30-day at-the-money option a year ago. Okay? So that's what VIX is, measurement of the S&P 500 in the marketplace. We're going to wrap this up. You can send your questions in to Mark. He or his very able staff will get to these shortly, if not today, certainly on Monday. We're going to take a very short break. Dan Grams is going to come up. If you haven't seen Dan before, he is outstanding. Okay, I think you're going to get a big kick out of him. So thank you very, very much, all you people in line and everybody here in Naperville. Thank you.